So far we have been talking about fluctuations of share prices within a day, but share prices are not only volatile hour by hour in the sense that we have been thinking about, or even day by day if you track a share price across a month. So there may be actually large kind of like systematic movements in share prices, which actually occur over play out over different years, right? So you have got basically large swings where you have got shares which are going up across different years, and then you have got shares which are coming down, right? So as an example of such a situation, let's look at what happened to the value of this Nasdaq Composite Index between the years 1995 and 2004. So what do we mean by an index? So this is basically a weighted average of prices for not just one particular company, but for a different set of stocks, right? So this is like there you have got these different indexes such as Sensex. So this was another such example, right? And at that time, the Nasdaq Composite Index included actually many fast growing and hard to value companies in the tech sector. Okay. So this is how the picture looked like for this combination of these different stocks which were included in the Nasdaq. So you can see that from 1995 till around mid 2000, they've got basically a large upswing in the value of this index, and then you have got a kind of a downswing, right? And this is kind of like going on. The bottom kind of happened around um, 2002, and then it again started to go up, but of course not back to that previous peak level, right? And in fact, we can quantify this also just to put some numbers up behind this graph. So basically, this index began the period at a value less than 750. So you can see initially the value was around less than 750, and then it rose in 5 years to more than 5,000, right? So this is around the peak, with a remarkable annualized rate of return of around 45%, which is huge if you consider about what is happening to stock prices these days. And then it lost two-thirds of its value in less than a year and eventually bottomed out at around 1100. So it kind of like fell around 1100, which was almost 80% below the peak of more than 5,000, right? And this whole episode of this rise and fall in the stock prices of this index, this episode came to be known as the tech bubble, right? So what do we mean by bubble? Because we hear these words these days often in the news as well, right? When you hear about there's an AI bubble going on. So bubble is actually kind of like a technical word. And what it means is that there's a sustained and significant departure of the price of any asset. This can be financial or otherwise from its fundamental value, right? So we already discussed briefly what we mean by fundamental value. We'll define it formally later on. But again, informally, bubble means that you have got not only a departure for a small amount of time, but for a significant amount of time, and a departure which is huge, right, from its fundamental value. So what's going on? So sometimes you have got that new information about the fundamental value of an asset is quickly and reliably exposed in the markets, right? And changes in beliefs about a firm's future earnings growth results in virtually instantaneous adjustment in its share price, right? So that would kind of like mean that you have got both good and bad news about different patents that the firm has filed or lawsuits involving the firm. Illness or departure of important personnel, earning surprises, mergers and acquisitions. These are all events that can lead to kind of changes in belief about the firm's prospects, and that can result in active trading and swift price movement, right? So that's why we can kind of like think about like, movement in stock prices reflect basically all this new information that is coming in, right? So because you have got the stock price movements often reflecting important information about the financial health of a firm, perhaps you have got traders who do not actually have a lot of different information that is available, right? They may have access to some information, but not all of this information. And then they can try to kind of like deduce it from the price movements, right? So basically what we are saying is prices reflect information, but if you do not have information, you can try and like kind of look at prices to think about what does it tell you about the firm's health, right? So that means that changes in prices in this story are basically messages containing information, right? And if you've got that the markets are working well, then the traders also need to respond to these messages, right? That is coming around about what is kind of like the most recent information about the prospects of the firm, right? However, that is one side of the story where you have got this interpretation of the changes in the price as basically changes in information. But there is also another side of the story, which is based on our discussion of this momentum trading strategies that we talked about, right? So when you have got traders which start to interpret a price increase, not just about the information content of that price increase, but as a sign of future price increases, then you might have basically kind of like traders just betting on that the price will increase further. And a result of that, taking actions, which would involve buying a lot of the stock, which would lead to actually future price increases happen, right? So this is kind of like self-reinforcing cycles of price increases. And this might actually result in asset prices kind of like moving away from the fundamental value. And therefore, it results in asset price bubbles. And when finally the correction happens, then you have got basically price declines, which are again also very sudden. And these are then basically what are known as financial market crashes, right? So what makes it special about asset markets that you have this kind of like this occurrence of bubbles and crashes that can happen in such markets, right? So there are actually three distinctive features about these markets. One aspect is that you have got the items being traded have a resale value, right? So basically, because you have the opportunity of reselling these items as compared to a lot of items that you might be buying on a day-to-day basis that do not have that much resale value, then assets basically offer the opportunity for speculation on a change in its price, right? So if you have purchased houses, paintings, and so on, you may also have an opportunity to resell them, and as a result of that, you can kind of like have this sort of phenomena happening. The second distinctive feature about asset markets is that you have ease of trading, right? So in financial markets, ease of trading would mean that it's often very easier to switch between being a buyer and being a seller. The same person can actually fulfill both of these roles, and as a result of which you again have this phenomenon of bubbles kind of happening, right? The third important determinant of bubbles forming is the ease with which you can borrow to finance purchases, right? So if you have got that market participants can borrow to increase their demand for an asset, right? So suppose that you think that there's an asset that's going to increase in price, but in order to take advantage of that increase in price, you need to first borrow it, right? First actually buy the asset. Now, this becomes much easier in an environment where it's easier to borrow, right? So for example, if it is cheaper to take out loans to purchase these assets, then kind of like you might engage in such behavior and they try to take advantage of the asset price going to go up in price, if that is what you think, right? So then, for instance, we'll see that bubbles are kind of like more likely to form whenever you have got a low interest rate regime, right? Because it's easy to actually borrow to finance these purchases, right? Okay, so you've got basically kind of a scenario where you've got asset prices can swing wildly, and that would typically give rise to the impression that perhaps they bear very little relation to the actual kind of like prospects of the company, right? However, just to kind of like make it clear, there is a lot of controversy about this idea of bubbles, right? So there is a lot of debate, and we will kind of like see elements of this debate later on in this course about do bubbles really exist? Or are they just an illusion based on hindsight, right? So in particular, if you are in the middle of a bubble, do you actually can know that whether the market is experiencing a bubble or not, right? Maybe it's kind of like this time is different and you are kind of like in a world where prices are going up just because the future prospects are much better, right? So you can see that the same kind of like this debate plays out so many different times. This played out during this tech boom period. We'd see that there was a similar debate during the events surrounding the housing market. There's also a similar debate going on now about the AI kind of like industries and so on, right? Okay, so just to kind of like give you a brief picture of different sides of this debate, you have got actually kind of like famous economists, in fact, Nobel laureates having different stances on this, right? So one such famous economist is Eugene Fama, who again is a Nobel laureate, and these are his words. So he's saying that words such as bubbles have become popular, but he doesn't think that they have any meaning, right? So in his opinion, it's easy to say prices went down. It must have been a bubble after the fact. So just because you have this kind of like this negative thing, sharp fall, then you say that perhaps it's a bubble, right? But you are kind of like only be able to say that after the prices have gone down, right? So these are things that you can only claim in hindsight, right? But he says that, you can always find before the crash that there are people who are saying that prices are too high, right? When they turn out to be right, then we say that, okay, they are the ones who predicted the bubble. But when they turn out to be wrong, you just ignore them, right? However, these are people who are typically right and wrong about half the time, right? So basically, you cannot, in his opinion, you cannot predict that there is a bubble in the middle of a bubble. In fact, he doesn't think that there's such a thing as a bubble, right? So this actually ties into what is known as the efficient market hypothesis, which says that all generally available information about the fundamental values is incorporated into prices virtually instantaneously, right? So basically, all the information that you have that can affect the valuation of the stock, that is already incorporated in the prices almost instantly, right? And the idea basically saying that if you have a formula which says the price of a stock is going to go up next week, then you would anyway immediately buy the stock today, and that would result in the price of the stock going up this week only, right? You won't have to wait for next week, right? So therefore, you cannot like predict that the price of the stock can go up next week, because that information itself will be acted upon today so as to nullify that prediction. Okay. However, there have been people who have pushed back against this argument, and they have said that, kind of like, even if you think you are in a bubble, right? You don't know beforehand at what time will others kind of start trading against the bubble, right? And this uncertainty about when will kind of like people start trading against the bubble is what makes you nervous about trying to kind of like sell too early, right? So therefore, even if you think you are in a bubble, you may prefer to keep on buying, right? Because you don't want to kind of like lose out and on the gains that would be happening before the bubble bursts, right? So that's one thing. And there are kind of like statements by, for example, the Citibank CEO in the context of a market that we'll discuss later this week, which says that this is about the house, particularly about some assets related to the housing market. So the CEO is saying that when the music stops, things will be complicated, right? When the market crashes, things will be complicated. But as long as the music is playing, as long as there is trading going on in this market, you have to continue to kind of like trade in this market. Otherwise, you'll be losing out compared to your peers, right? So we'll see, by the way, what was the consequence of this sort of reasoning in that market later on, right? So as opposed to Eugene Fama, you have another Nobel laureate. In fact, they won the Nobel Prize in the same year, by the way, Robert Schiller and Eugene Fama, who have kind of like argued that actually their bubble is actually a thing that exists. And there are actually relatively easier ways of figuring out whether there is a bubble going on or not, right? So you can use simple and publicly observable information, such as the ratio of stock prices to earnings per share, to identify bubbles as they form. And you can kind of like devise strategies which actually kind of like will take advantage of the fact that you have figured out you're in a bubble, that can do better than just kind of like investing in mutual funds in the stock market at a particular value and thinking that the stock market is actually accurately reflecting all the information that is available, right? So we can basically summarize these two different viewpoints in terms of how they thought about this phenomena that we identified as the tech bubble. So in Eugene Fama's view, the price rise and fall that we saw during that tech bubble, that picture just that we saw, that actually reflects the information that was best available at that time. And the fluctuation happened not because there was a bubble, but because the information about the prospect of these companies were constantly changing, right? So initially you had a lot of information which indicated that the company would be doing very well. And then basically you had a lot of information which says that the company would not do as well as expected. And so that's why you saw that rise and fall, right? However, in the opposite view, which is Robert Schiller's view, his view of that picture was that basically you had the prices in the late 90s were driven up simply by the expectations that the price would rise still further, right? Not by about any information about the fundamental value, but because people thought that price would rise further, that's why they were interested in buying more. And this created this cycle where prices kind of like goes up, right? And so he called this phenomena basically irrational exuberance among investors. And we'll have like lots more to say about these things as we discuss later on in the course about this efficient market hypothesis versus this more behavioral finance kind of like approach towards thinking about bubbles. So that's again something that we will discuss in more details in the course as we move.